Hello and welcome to Explain the Charts. Today is November 11th, 2025, and we're analyzing the Nasdaq 100 ETF, ticker QQQ. We're currently seeing a major split in the market. The Dow is rallying to new highs, but the tech-heavy Nasdaq is showing signs of weakness. This divergence is driven by a flurry of news concerning high valuations in tech, especially within the popular AI sector. Let's first cover the news before diving into what the charts are telling us. Several reports today are highlighting this pressure on tech. CNBC and Barron's both note that while the Dow is strong, the Nasdaq composite is falling. This is largely attributed to what's being called AI trade fatigue, where investors are becoming wary of the sky-high valuations of artificial intelligence stocks. We saw this materialize with CoreWeave, an AI infrastructure provider, whose stock slid over 16% after providing disappointing forward guidance. Adding to the bearish sentiment, SoftBank announced the sale of its entire stake in AI leader Nvidia for over $5 billion, a move that has certainly spooked some investors. Furthermore, famed investor Michael Burry has accused major cloud and AI providers of aggressive accounting, which casts another shadow over the sector. On the macro front, concerns about the record-long U.S. government shutdown persist, and recent data from ADP suggests some weakness is creeping into the private sector job market. Yesterday's market did see a strong rally on hopes of the shutdown ending, but today those valuation concerns seem to have taken center stage once again. So, with that context, let's see how this narrative is reflected in the price action on our charts. Looking at the daily chart for QQQ, we can see the broader story of the last year and a half has been incredibly bullish. After a volatile period in early April, the price began a powerful uptrend, climbing from a low of around $402. This massive run-up culminated in a new all-time high just a couple of weeks ago, on October 29th, right around the $637 mark. However, since hitting that peak, the price has seen a sharp reversal. We can see a series of strong red candles in early November, which coincides directly with the negative news cycle about AI valuations and the Nvidia stake sale. Notice the high volume on those down days, such as November 6th and 7th, which suggests strong conviction from the sellers. Yesterday's candle, for November 10th, is a very strong bullish candle, representing the rally on hopes the government shutdown would end. However, as the news suggests, we are seeing a pullback today, indicating that yesterday's strength may have been short-lived. The price is now caught between that recent high, which acts as major resistance, and a developing support zone. Before we look at the shorter time frames, I want to highlight the last time we saw this kind of volatility. If we filter our daily chart to focus on early April 2025, you can see the enormous price swings and massive volume. On April 4th, we saw a plunge of over 3.5%, followed by a period of extreme chop, and then a massive 12% gain on April 9th on incredible volume. This period established a major support level in the low 400s, which serves as the foundation for the entire rally that followed. Understanding these historical zones of high volume and volatility is key to identifying major long-term support levels. Now, let's zoom into the more recent price action. Switching over to the 1-hour chart, we can examine the recent sell-off and yesterday's rally in more detail. Here we can clearly see the sharp decline that started around October 29th. The price fell from around $637 down to a recent low just under $617 yesterday morning, before staging a powerful recovery throughout the day. This recovery took the price back up to test the $624 level, which acted as resistance. Currently, the price is in a tight consolidation range. Immediate support on this time frame is the low from yesterday around $617, with resistance at the $624 to $625 area. A break below $617 would suggest the downtrend is resuming, while a break above $625 could signal the bulls are regaining control in the short term. The battle between these two levels is critical for the next directional move. For an even closer look, let's pull up the 15-minute chart for the last couple of days. Here you can see the character of yesterday's rally. Notice the strong, impulsive buying that occurred in the early afternoon, pushing the price up with significant volume. However, the rally began to stall as it approached the 624 level, followed by sideways chop into the close. This shows that while buyers were aggressive off the lows, conviction started to wane at higher prices. Today's pullback, mentioned in the news, will likely be testing the support levels established during this recent consolidation. So, let's go back to the daily chart to summarize what we should be looking for. Let's outline the bullish and bearish cases from here. The bullish case is that the correction is over, and yesterday's rally marked a successful defense of the 617 support level. For bulls to gain confidence, we would need to see the price reclaim and hold above the $625 resistance area. If that happens, a retest of the all-time high at 637 becomes much more likely, especially if we get positive news regarding the government shutdown or a calming of AI valuation fears. The long-term uptrend, after all, remains intact. On the other hand, the bearish case is supported by the negative news flow and the high-volume selling we saw from the peak. If the price breaks below the immediate support at 617, the next major target for sellers would be the psychological $600 level. This level also aligns with some consolidation we saw in late September. A break of 600 would be a significant bearish development and could open the door to a deeper correction, potentially towards the 580 to 590 zone, which was a key resistance area back in September. So to recap, the key levels to watch are resistance at 625 and the all-time high of 637. Support is at 617, followed by the major psychological level of 600, and then the 580 to 590 zone. My unbiased take is that a period of choppy, sideways to downward consolidation seems slightly more probable, with about a 60% likelihood. The weight of the valuation news is significant, and a retest of the 600 to 617 support zone seems likely before a new trend emerges. This view would be reinforced by a daily close below 617. The less likely scenario, at about 40%, is that the bulls take decisive control from here. For this to happen, we would need to see a strong close above 625, indicating that the market has absorbed the negative news and is ready to resume the uptrend. Keep an eye on the news cycle, particularly around tech earnings and the government shutdown, as they will be major catalysts. Finally, a quick disclaimer. This video is for informational and educational purposes only and is not financial advice. You should always conduct your own research and consult with a financial professional before making any investment decisions. Thank you for watching Explain the Charts.